Hi, this is Tony Hodson, Senior Vice President of Market Data for the OTC Markets Group and founder of Qaravan. I'd like to thank the TBA for inviting us and for making this format possible in a virtual conference. When we were originally invited to participate, we were planning on a segment around data-driven performance benchmarking, but then things have changed rather drastically recently, so we thought we'd reshape that into a COVID context, recognizing that performance benchmarks are now changing in some pretty fundamental ways. So in that way, benchmarking becomes even more important because what we assume to be true about our business models is now being redefined to what may be a new normal. I'll start the presentation today with a brief introduction of Qaravan and the OTC Markets Group, and then we'll get into content about how this pandemic may affect the way we view bank performance in the near future and longer term. To start with, just a brief slide about Qaravan. What we do is take regulatory data, consolidate it, and present it in a format that is much easier to use. So essentially, we're taking these static reports like a call report, UBPR, summary of deposits, reports of structural changes, as well as some bank holding company data, and we're putting it into a large data warehouse and organizing it into software tools that you can use for reporting, analysis, benchmarking, and our regulatory clients also use it for offsite supervision and exam scoping. In February of 2019, Qaravan was acquired by the OTC Markets Group. If you're not familiar with the OTC Markets Group, we operate 3 different marketplaces that cover about 10,000 US and global equity securities, and a large number of those are in the US banking sector. Over 500 banks trade on OTC markets with a total market cap of a little over $300 billion, and year to date, for 2020 alone, we are already approaching $1 billion in trade volume for those securities. In 2014, OTC started the QX market for banks, which was designed specifically for regional and community banks. Today, there are 100 banks trading in that market, with asset sizes ranging from 100 million to 4 billion, squarely in the community banking space. Together, these banks have a market cap of about 8 billion, and they see a higher level of liquidity with 21 million shares and 336 million in dollar volume traded year to date. One other benefit for the QX banks is a reduction in their regulatory burden. So their reporting and disclosure requirements can be met using the reports that they provide to regulators like the FFIEC, the Federal Reserve, and the FDIC. SEC reporting is not required. And then lastly, if you look at the chart below, we're proud of the OTCQX Banks Index. As you can see, it's consistently outperformed the S&L US Banks Index. This is the first of 3 unfortunate slides. The bad news is the recession is already here. Just recently, the NBER has confirmed we've seen the 2 quarters of negative growth that are typically used to identify a recession. And really, despite that technicality, any way you slice it, there are plenty of indicators that we are in a slump and we will be for some time. When this happens, economists tend to look to recessions of the past to determine what our recovery might look like. The reality is we just don't know yet. Those different scenarios, those different shapes, rely on a set of assumptions that are pretty shaky. For example, an assumption that we develop a vaccine at a certain period of time, or an assumption that we adapt in a particular way without a vaccine. These are things that we just don't know if and when they'll happen. So each of these scenarios has a significant amount of doubt associated with it. And one thing that's particularly important to keep in mind about this pandemic, this economic recession, is that it's significantly different. And every time we go through one of these, we feel like this time is different. But as you can see on this slide, this one truly has a number of factors that make it historically unprecedented. The first is the cause. This is not a function of economics and asset bubbles or energy. This is what some are referring to as a global natural disaster. The next thing is the impact. It's been global, severe, and enduring. The enduring part is, I think, particularly relevant to note because this is what carries so much uncertainty. The broad nature of it being global and the severity of it in terms of the loss of life and unemployment and markets crashing, those are truly heartbreaking. But what makes this difficult to cope with is that we don't know how long it will last. And then when we look at the response to this, we can see it's different than responses in the past as well. We've seen record levels of injection into business, markets, and citizens directly. We see a monetary policy that doesn't have a lot of room to move in terms of where interest rates are. And we see a total social shutdown across the globe. In the next few slides, I'll talk a little bit about benchmarking a new normal. And the idea here is our framework for what good looks like will be turned on its head. Perhaps temporarily, but in some ways it's likely to be more permanent. So one thought exercise that I think is interesting is to put yourself in the shoes of a banker during the 2008 crisis. So I picked 3 metrics that broadly describe capitalization, liquidity, and earnings. And what I wanted to highlight here is you're looking at the median value for all U.S. banks year end for each of the years indicated here. And across these 3 metrics, you can clearly see the shock and then what the recovery looked like. And if you put yourself in the shoes of a banker in 2008, which many of you were probably there, imagine what you were thinking in Q4 2008. Few bankers knew at that time that we wouldn't return back to the good old days. There would be some things that would be forever impacted. That's something we have to challenge ourselves on today as we're considering disruptions to the way that our businesses are functioning. Which of those disruptions will be temporary and which will be enduring? So as we approach a similar challenge with COVID, one of the things that will remain important is to remember context. The question of how are we doing should always be answered with the question compared to what. And I pulled this chart as a good example of what that means. If you look at the orange line, we're looking at a bank in Dallas that is concentrated in CRE lending. If we compare that Dallas bank to other U.S. banks concentrated in CRE, they're consistently outperforming that benchmark. Then when we look at that bank relative to other Texas CRE banks, they're again outperforming, maybe not to the degree they were nationally, but certainly they're still outperforming. But then if we compare that Dallas CRE bank to other CRE banks in the Dallas area, we see that it's actually a consistent underperformer. Now there are surely reasons for that in their business model and the business model of the other Dallas CRE banks. But the important takeaway here is that when we're gauging how this bank is doing, it really depends on who we're comparing them to. Next, I want to talk a little bit about the way we see benchmarking evolve inside of a banking institution. Over the last 6 years, I've worked with hundreds of banks, both as clients and as participants in the American Bankers Association's course on analyzing bank performance. And one of the things I've seen is that most banks tend to go through a bit of an evolution in the way that they approach benchmarking. Almost every bank does some sort of trend analysis on their own data. So essentially benchmarking against themselves. Us today versus us yesterday. That's a pretty common scenario, and I would hope that every bank is doing that. So then we see banks will want to expand that a little bit and compare themselves to other banks. And so what we see is the next step is banks will want to know, well, what about the banks around us? How are they doing? And so geography tends to be top of mind. And so they start to compare themselves against other banks in their area. Sometimes that's the local area, sometimes that's more regional, but in general there tends to be a focus on geography. And then once banks get comfortable with the geographic focus, they start to look more closely at those banks in their area and realize that those banks don't look much like them. That it may be more relevant to use some other criteria than geography. Because just because a bank is in your neighborhood doesn't mean that they're running the same type of business that you are. So then banks tend to move up that chain a bit and move towards balance sheet benchmarking, where they start to look for banks that are funded like them or banks that lend like them. And they start to look at the nuances of their balance sheet relative to other balance sheets and their operations relative to other bank operations. And so the next logical move is to take that group of banks that look like us and start to deconstruct the best of those banks. So rather than just compare ourselves to the median and determine that we're better than average or worse than average, we want to start to compare ourselves to the best and try to figure out what is it that the best banks that look like us, what is it that they're doing that we're not? What we tend to see is most banks are focused in those first two areas, trend and geography. And there's some good reasons for that. The data, while it's readily available, is sometimes a little overwhelming and a little difficult to work with. So I'll show you in the next few slides kind of a 4-step process that we use to help break down the approach to creating a peer group. And I think once you see that process, you might feel a little more comfortable with how to approach things like balance sheet or performance benchmarking. And I am, of course, more than a little biased here because I think our software does a great job of making short work of this. So you'll see some screenshots from our software and how Qaravan approaches this. But just keep in mind that these 4 steps are the same process, whether you're accessing it through Qaravan or directly through the regulators. In the first step, think of it like you're starting with the universe of all banks, and then you're applying a series of filters to winnow down those groups. So the first thing is to select what those filters would be. And in this case, we are selecting a filter on location, MSA, Metropolitan Statistical Area. We're selecting a filter associated with size, and in this case, just total assets. And then we're also selecting a filter based on concentration. And in this case, we're looking at C&I loans as a percentage of total loans. So what we're looking for is banks that have some unique combination of characteristics relative to these 3 filters. In step 2, we will apply filter criteria. And in the case of the MSA, we're looking for banks in the Dallas-Fort Worth-Arlington area. In the case of the C&I concentration, we're looking for banks that have more than 25% of their loans in C&I. And then lastly, for size, we're looking for banks that are less than $1 billion in assets. In the third step, you simply give the peer group a name and save it. In Qaravan, of course, this is a relatively simple process, but I think this is important if you're doing this outside of Qaravan in Excel spreadsheets or otherwise manually, because sometimes you might forget who you have included in that peer group and how you arrived at that peer group in the first place. And then lastly, for future analysis, you just apply that peer group to information you're interested in understanding. So in this case, we're looking at net interest income as a percent of average assets, and we're comparing a bank to that new DFW C&I Banks peer group that we created. So if you're starting to get overwhelmed with the idea of more sophisticated benchmarks, just break it down to these 4 steps, and I think that will help. In the near term, banks are already starting to think about how COVID will impact their business model. We're hearing questions around things like staffing, credit, delinquencies. And what I hope you're able to take away from this webinar is that there is data available to help you answer these questions. The banking sector is subjected to a huge amount of regulatory burden, but a benefit of that is a huge amount of publicly available data. For example, with the question of staffing, question may look something like this. We've had to lay off a few employees. How common is this? And there are a number of metrics we've highlighted here that can be pulled from both call reports and UBPRs to help highlight what changes are looking like from a staffing perspective. So for this one, at the chart at the bottom, we've picked a $500 million Texas bank that's asking this question, and we put them against other Texas banks that are less than $1 billion in assets. And while this bank did see a slight reduction in staff from last quarter, it looks as though their peers, at least in this peer group, did not see that. Similarly, with the question on credit, one thing that several banks have mentioned to us is HELOCs are being used more. And so there's a question of, is that happening at other banks as well? And so here's a different bank, $600 million bank in Texas. And this particular bank has a decent sized business in HELOCs. You can see there's all sorts of metrics, again, that you could look at to try to glean some information. We picked one in particular around unused commitments. And relative to this peer group, it seems to be something that other banks are experiencing as well. Around delinquencies, I think a lot of banks are wrestling with this right now. We're adjusting our ALLL, or we're thinking of adjusting our ALLL, how our allowance is changing at other banks. And so this is a Texas CRE bank, and we've benchmarked it up against other Texas CRE banks. And we can see this bank, clearly in blue, has significantly increased their ALLL. And when we look at other CRE banks, we can see they've done similar. It's not quite as drastic, but that could be for a variety of reasons. In the last few slides, we've been looking at some of the more recent questions that banks are looking at. But there's also a set of looming questions that we're all trying to get our hands around. So the idea here is just to recognize that, again, like those other questions where we're already starting to see some answers in the data, we don't know the answers to these yet, but the data will be our guide. We can reliably look back at the data and start to see how's it impacting us relative to peers. In the last section, I want to offer a handful of tips on benchmarking in general, and in some cases, benchmarking in particular in volatile markets. So the first is to focus on trends and anomalies without getting lost in the weeds. The difference between trends and anomalies being lost in the weeds can pretty clearly be seen between the two images we have. On the left is the way Qaravan renders a section of the UBPR report. The visualizations that you see around the trend lines and the percentile rankings, those spark lines and bullet charts, are actually rendering several hundred data points underneath there. But your eye is able to look at the lines and look at the charts and very quickly draw some conclusions without having to get bogged down in the details of the numbers. Whereas on the right, we're looking at the actual table of nominal values for that same section of data as it's rendered in the regulator's UBPR. So on the trends and anomalies side, you're really just trying to look directionally for how things are going. Up or down, fast or slow? Is it consistent or choppy? How are you doing against peers? Is it significantly better or significantly worse? Unfortunately, what we sometimes see is banks get lost in the weeds. This tends to manifest itself in a handful of ways. One is to focus too much on the nominal values of the metrics you're looking at. So, a number like 1.34 versus 1.38. It's sort of irrelevant, and it becomes a much bigger distraction when you're looking at a broad spectrum of metrics over a period of time. Second one is we sometimes see banks are unable to zoom out enough to see broader trends or cycles. So if you think back to that slide I had shown earlier where we have this bank that had a little bit of seasonality in a part of their business, if you're focused too much on year over year, for example, you may not notice that. sometimes you got to pull back a little bit so that you can have a better appreciation about the broader trends and cycles. So the next one is do evolve your approach to identifying peers. So as we discussed before, moving up that evolutionary arrow can provide much more valuable benchmarks for you. One tip I'd offer here is the last bullet on this slide. It's important to make sure that you're looking for best practices rather than just trying to use the data to confirm what you're already doing. Having said that, don't let perfection get in the way of progress. So one pragmatic thing I point out on this slide is the second bullet, the importance of broadening your peer group filters. There's a tendency when you're first starting to want to find banks that look exactly like you. But the reality is there's not that many banks in the US. So by the time you slice it and dice it down to your finite criteria, what you might find is there really are no other banks that are exactly like you. So you have to start to broaden your lens a bit. Sometimes what this might mean is that if you're a $500 million bank, you might have to look at banks between 250 million and 1 billion. Or instead of looking at banks in your zip code, maybe you want to look at banks in your county. The next tip is to use different peer groups for different contexts. So when we think of that evolution of benchmarking, it kind of gives the false impression that the next benchmark is better than the last. So as you move up, you're doing things better. And that's not what I want you to walk away from this thinking. What it's meant to suggest is that there are increasingly sophisticated ways to benchmark, but all of the ways that we approach benchmarks can be valuable in a given context. For example, you might have one set of peers that have a funding strategy that's like yours. You might have another set of peers that has a lending portfolio that's like yours. And you might do that because you're interested in cost of funds based on banks that are funded like yours, and maybe yields based off of banks that lend like yours. So you may be trying to answer sort of two different questions, and that requires two different peer groups. Similarly, something like geography, which is thought of as a pretty basic fundamental benchmark, is still very valid, particularly when it's related to items that are closely tied to geography. So things like occupancy costs and staffing, efficiency ratios, these things, there are high-cost regions and low-cost regions, and so it in many cases is important for you to benchmark yourself geographically. And lastly, don't ignore the role of risk. There tends to be a lot of focus on high-performing banks, and those tend to be measured in terms of ROE and ROA. We've all seen the lists, the top 100, the top 50, etc. What some of those banks have in common are they're making some risk trade-offs. Sometimes they're accepting higher concentrations. Sometimes they're taking on a slightly lower credit quality. Sometimes they're fueling their growth in ways that a more conservative bank would feel uncomfortable with. That doesn't make them bad banks, but it just recognizes that risk and return are intrinsically linked. So as you're looking to be a top performer, it's important for you to consider the role of risk there and consider your performance relative to your risk profile. It looks like this is my last slide, so I'd like to thank you for joining, and I'd like to thank the Texas Bankers Association for hosting us. My contact information is on this slide. If you're interested, you can reach out to me directly. If you have questions about Qaravan, we'd be happy to set you up with a demo or a free trial. If you have questions about benchmarking in general, I'd love to have that conversation as well. I'll be available in the web conference chat, so I look forward to chatting with you. Thank you.